I spent the last 10 years building an 8-figure portfolio from scratch through a mix of real estate, index funds, crypto, etc. And I still see the same patterns in Reddit investing threads. The same questions come up over and over, leading to the same mistakes and the same missed opportunities. When you scroll through Reddit, you see endless opinions pointing in different directions. One person says sell everything, another says double down. Instead of getting more clarity, you often walk away even more unsure of what to do next. Over the past month, a few threads really stood out to me. Should I sell all my VOO to buy AI stocks? Or did I miss out on the boat because markets are at all-time highs? Or what should I do with $240,000 sitting in Nvidia? Today, I'm going to break down the top rising posts from Reddit investing and show you exactly how I think through each one and what I would avoid and the approach that actually builds lasting wealth. Let's get into it. This is the kind of post that gets people fired up because it taps into two of the strongest investing emotions, greed and regret. People love sharing their wins, but for every big win story you see, there are hundreds of quiet losses. But the difference is nobody's rushing to post about their stock that wiped out half of their portfolio. And I saw this play out in 2020. Friends turned a few $1,000s into 6 figures on meme stocks and options. 6 months later, many of them were back where they started. The common thread was the same. They never really understood what they owned or why they owned it. If Reddit helps you discover a stock and you take the time to research the business, understand the financials, the competitive advantages, and the risks, then that can be a good starting point. But if it's just a ticker that popped up in a thread with thousands of upvotes, that's not investing. That's following the crowd and hoping they're right. The real skill here is separating information from noise. So you want to ask yourself, do I understand how this business actually makes money? Or do I know what would make me sell other than fear? Or even, does this fit into my overall portfolio strategy, or is it just a gamble? So no, I'm not going to give you my most successful stock from Reddit. The advice I just gave you is worth a lot more than a single ticker symbol you might just chase and regret later. The goal isn't to get lucky once, it's to build wealth that survives and grows over decades. And that comes from a repeatable process. This question comes up every single week, and it's always starting in the wrong place. The ticker symbol isn't where you begin. The better question is, what are you actually optimizing for? Do you want fast capital growth, consistent income, protection against inflation, or a way to reduce your taxes? Each goals point to a completely different portfolio structure. If you're 25, you have time on your side. That means you can take more calculated risks because you can recover from market downturns. Now, this isn't financial advice, but in that case, I consider something like 70% in broad market index funds like VTI or VOO, 20% in a few high conviction individual companies, and 10% into speculative plays they can afford to lose entirely. Every dollar you earn from dividends or gains goes straight back into the portfolio to maximize compounding. If you're 35 and looking to protect what you've already built while still growing, the structure might shift. You might still hold index funds for growth, but add more dividend-paying stocks for income, real estate for tax efficiency, and a cash or a short-term bond position for flexibility. Your speculative bucket might shrink to 5% or less because capital preservation starts to matter just as much as growth. So instead of asking, what should I buy right now? You should ask yourself, what structure gets me to my goals with the least unnecessary risk? A 25-year-old and a 35-year-old will have different answers, and that's exactly the point. The ticker is never the point, the structure is. Psychologically, yes, it can feel tough to buy at record highs. It's easy to think you missed a discount and that the smart move is just to wait for a drop. But that mindset is a trap. The market has hit new all-time highs hundreds of times in history, and it will likely do it 100 times more. If you only invest when it feels cheap, you're going to end up sitting in cash for years while the market keeps moving without you. I've watched it happen over and over again. In 2017, 2019, 2021, and now 2025, there were people saying, I'll wait for it to come back down, and most of them are still waiting. And the longer you wait, the harder it gets to pull the trigger. What I do instead is keep buying on a set schedule. Whether prices are high or low, it's called dollar cost averaging, and it works because it removes the guesswork. Some months you buy more shares because prices are down, other months you buy fewer because prices are up. But over time, your average cost balances out. If you have a lump sum to invest, you can split it into chunks and deploy it over the next 6 to 12 months. That way you're not trying to time a perfect entry, but you're also not trying to throw it all in one day. The goal isn't to buy at the exact bottom, it's to be in the market long enough for compounding to work in your favor. I'd rather look back in 5 years knowing I participated in the growth than regret sitting on the sidelines because I was waiting for a sale that never came. I hear this every time markets get choppy. People say they're getting out to wait for clarity or avoid the crash. And more often than not, those calls happen right before a rally. Now, the few times they're right, they get to say, I told you so, but usually only once every decade. And honestly, I never met anyone who consistently called the top, sold everything, and then bought back in lower without missing the rebound. Even professionals with decades of experience get this wrong more often than they get it right. The market doesn't reward fear, it rewards consistency. Every time you jump in and out, you're not just risking missing the upside, you're also exposing yourself to inflation eating away at your cash. If the market is up 10% while you're sitting on the sidelines earning 4% in a savings account, you already lost ground. What I do instead is manage my allocation based on my goals and risk tolerance. If I think there's going to be a lot of uncertainty, I might shift more into defensive positions, hold a little extra cash, or rebalance towards sectors that tend to hold up better in downturns. And that way, I'm reducing risk without stepping completely out of the game. Selling everything and trying to time your way back in is like trying to jump on a moving train. You might get lucky once, but the odds are stacked against you. I'd rather stay on board, adjust my seat, and keep moving toward my destination. Yes, and I got it as soon as my net worth passed $1 million. If you're building wealth and you don't have one, you're playing with fire. I've seen people lose half of what they spent decades building because of one unexpected lawsuit. And it doesn't have to be something dramatic. It could be a car accident where the other driver's lawyer comes after you, or someone getting hurt on your property. The reality is, once your net worth hits a certain point, you become a target. If someone thinks that you have deep pockets, they're going to go after you. And without an umbrella policy, your personal assets are exposed. The cost is surprisingly low, often just a few $100s a year for $1 to $5 million in additional coverage. That's a small price to pay for peace of mind and protecting everything you've worked for. Umbrella insurance isn't exciting, you'll probably never brag about having it, but the day you need it, you'll wish you had bought it years ago. It's the financial equivalent of a firewall. It's invisible most of the time, but it's essential when something goes wrong. In the short term, I'd say 80% of investing results are driven by luck. Over the long term, 80% comes down to behavior. Anybody can get lucky picking a stock that doubles in a few months, but the real test is what happens next. Do you hold through a 40% drawdown? Do you know when and how to rebalance? Do you keep adding capital even when headlines say the market is doomed? That's where skill shows up. You can stumble into a win by accident, but staying wealthy and growing wealth over decades takes intention. It's about controlling the things you actually can't control, like automating your contributions so you can invest consistently in all market conditions, rebalancing to keep your portfolio aligned with your goals, using tax strategies to keep more of what you earn, managing risk so no single position can destroy your progress. The market will always have an element of chance. You can't remove luck entirely, but the more you rely on process instead of predictions, the less your success depends on luck. I didn't build my portfolio by guessing the right tickers. I built it by repeating the same boring habits for years and letting compounding do the heavy lifting. This one hits home because that feeling of regret, even when you win, is real. I felt it myself. You can make a great return, but if you see someone else who made even more, suddenly your win feels like a failure. That's the trap of external benchmarks. If you measure your results against other people, you're going to always find someone doing better, and it's going to rob you of the satisfaction that should come from making progress. The antidote is building and sticking to internal benchmarks. My 3 questions are: did I follow my plan? Did I protect my downside? And did I stick to my rules? If I can say yes to those, I've already won regardless of what happens in someone else's account. It also helps us zoom out. You don't need to win every trade, every month, or even every year. What matters most is winning over the decade. If you keep stacking small, consistent wins, the compounding effect will dwarf the returns from one once-in-a-lifetime trade. One last thing, your strategy should remove as much decision-making as possible. The more you rely on reacting to the market, the more room there is for regret. Automating contributions, rebalancing on a set schedule, and defining your risk tolerance in advance keeps emotions from steering the ship. Now, you're not going to eliminate FOMO entirely, but you can keep it from running your portfolio. No, just hear me out. VOO is your foundation. It's a part of your portfolio that compounds quietly in the background and lets you sleep at night. It's broad, diversified, and designed to keep working through every market cycle. If you want to bet on AI or any other high upside theme, then that's totally fine. But carve out a small, clearly defined percentage for it. 5% is plenty for most people. That way, if it hits big, it moves the needle. But if it blows up, it doesn't take your whole plan with it. The danger here is when people take their safe, compounding core and they swap it for a hot hand because they are afraid of missing out. That's how portfolios get wrecked. It feels exciting in the moment, but one bad earnings report or a shift in sentiment can erase years of steady gains. Think of your portfolio in 2 buckets. The core is what makes you rich over time, like index funds, diversified ETFs, maybe some high quality dividend payers as well. The tilt bucket is what keeps you interested, like your individual stocks, speculative plays, but you have to keep the core intact, and you can take more calculated risks in the tilt without jeopardizing your future. Your goal isn't to hit one home run and hope it works out. It's to keep stacking base hits year after year until the score is so far in your favor that you can't lose. And if you turn your foundation into a gamble, you're not investing, you're literally just betting with nicer branding. Yes, a crash like the dot-com bubble can absolutely happen again. Every market cycle has its own version of a crash. The question isn't whether it will happen, it's whether your plan is built to survive it. I personally assume at least one 50% drawdown every decade. If my portfolio couldn't handle that without me panicking or blowing up my entire long-term plan, that's a sign my allocation is too aggressive. If you have 10, 20, or 30 years to invest, those crashes aren't just something to endure, they're opportunities. And in hindsight, the people who came out strongest from the dot-com bust were the ones who kept buying quality assets at depressed prices while everyone else was running for the exits. The key is to set up your portfolio so you can stay in the game. That might mean keeping enough cash or bonds to cover a few years of expenses, diversifying so one sector doesn't blow up your entire portfolio, or having a set contribution plan that continues no matter what headlines say. The market will always test you. If your only strategy works when things are going up, it's not really a strategy. Build something that you can stick with through the worst days, because that's where the best opportunities hide. If you're asking me, then the answer is absolutely yes. In my own portfolio, I own a good amount of Bitcoin, not because I think it's guaranteed to be the future of money, but because of the asymmetric upside. If you decide to add Bitcoin, treat it like a long-term hold and not a trade. That means buying a set amount, securing it properly, and ignoring the daily noise. Bitcoin is volatile. It can drop 50% in a matter of months, but with the right position size, you can ride that volatility without losing sleep. It's been the best performing asset over the last 10 years, and I think it's going to continue. I can make a more in-depth video on this if you want, just leave it in the comments below. Turning $800 into $240,000 is incredible. That's a once-in-a-lifetime win for most investors. Now, the goal is to make sure that you keep it. When a single stock makes up half of your portfolio, especially one that has had a massive run-up like Nvidia, the risk isn't just a price drop. The risk is that one earnings miss, reputation change, or industry shift could wipe out your years of gains. You don't need to sell it all, but if it were me, I'd trim 30 to 50% of that position, harvest those gains, and move the money into diversified, tax-efficient buckets like index funds, real estate, or retirement accounts. That way, you've locked in life-changing profit without walking away from the stock entirely. And one way to think about it is you already won the bet. The smart play now is to use the winnings to build a system that can keep working for you, even if Nvidia's best days are behind it. By trimming your position, you reduce your concentration risk, free up capital for other opportunities, and protect yourself from letting one stock decide your financial future. It's not about squeezing every last dollar from this trade. It's about making sure this win becomes a foundation for the next decade of wealth building, not just a story about what could have been. Now that this is officially signed into law, it's one of the biggest long-term compounding opportunities that parents will ever get. The setup is simple. The government seeds the account with $1,000 and you can contribute up to $5,000 per year. If it's fully funded and invested for 18 years, the child could have around $90,000 in contributions. And with growth, that could easily turn into a 7-figure portfolio by retirement. But here's the catch, only if you structure it right. Most people will either ignore it or fund it without a strategy. The families who will win big will treat it like a true tax-advantaged growth vehicle. That means investing into low-cost, broad market index funds, avoiding unnecessary withdrawals so compounding works uninterrupted, and also considering Roth conversions when the child is 18 to 23 and in a low tax bracket. This is one of those rare programs where the math is already in your favor before you even start. The only real mistake is not using it or using it without a plan. If I had a kid born after 2025, I set this up on day one, automate the contributions, and let time do the heavy lifting. And yeah, it's boring, it's simple, and in 50 years, it could be the smartest financial decision you ever made for them. All right, after going through these posts, one thing is clear. Reddit is full of good questions, but most of the answers won't get you where you want to go. Building wealth isn't about chasing the hottest tip or reacting to every headline. It's about having a structure you can trust in any market. That's the difference between feeling lost and feeling in control. This week, I'm going to be hosting a free live masterclass where I'm going to walk you through the exact system I used to build an 8-figure portfolio from scratch and the same system I still use today. It works whether you're starting with a few $1,000s or already managing a large portfolio. I'm going to leave a link in the description. You can join a live session, take notes, and start putting a real plan in place. I'll give you a proven strategy that you can actually use. And if you want more right now, you can check out my other videos where I break down how to legally cut your tax bill and also grow your net worth faster and protect your money from inflation. You'll find real strategies that you can use immediately. So with that being said, if you found this video helpful, please give it a like, turn on notifications or whatever those YouTubers say, and I'll see you in the next video.